Good afternoon, everybody. Welcome to our latest webinar. We're just obviously going to wait for a few minutes as people come in and join. So please don't be a stranger. Say hello in chat, introduce yourself, and let us know where you are today in a slightly less sunny UK than we've had over the last few weeks, in fairness. So I'll wait a couple of minutes and then we'll get started. So for those that are just coming through at the moment, we're just waiting 30 seconds or so before we start the session. Do familiarise yourself with the chat function that you have, and any questions that you want to ask as we go through the session, please use the Q&A. But do say hello and introduce yourselves on chat. Don't be a stranger. Okay, so I think the joining numbers are just starting to steady down now. So let's kick off. Good afternoon, all. Welcome to our latest webinar hosted from Giant on how to minimise financial risk and maximise profits in today's volatile recruitment sector. My name's Dan Haslam. I'm Group Sales Director here at Giant. I'm sure some of you will know we're a leading global contingent workforce management company based in the UK, and we help recruiters and end hirers manage their contractor and temp populations. Generally speaking, we're trying to help people do that in a cost-effective way and also reduce risk for them as well. And I'm going to host today's session. Delighted today to be joined by Dave Pickup from Verlingue. Verlingue are a leading credit insurance broker to the UK market, independent and family-owned business, and Verlingue have particular expertise in designing and placing corporate insurance and employee benefit programs for their clients. Also pleased to be joined by my colleague Alison Small. Alison is CEO for Giant Finance Plus, which is part of the Giant Group, and they offer outsourcing and finance solutions to recruitment businesses. Prior to joining Giant Finance, Alison's as CEOs had over 30 years experience working in the banking and finance sector, supporting businesses with their cash flow. So what we're aiming to achieve today, what we're looking at doing over the next 40 minutes or so, is just taking a bit of a deeper dive into the UK recruitment market with a particular focus on the current threats and opportunities from a financial risk and cash flow perspective. So we're really keen to try and balance the gloominess today. In a slow economy, you know, there's a lot of negative news in the press, but try and share some insight and some practical advice on what opportunities are out there in the market, and really encourage that business is absolutely being done out there, and the outlook is a positive one for businesses that are being proactive. So if I may, at the beginning here, just set the scene a little. Let's think about some of the challenges that we currently face economically. And I think to summarise that in one word, uncertain is certainly appropriate. At a macro level, we're seeing trade wars driven by tariffs and protectionist economic behaviours. It's obviously driving volatile market reactions. We've seen the way that the stock market's been fluctuating over the last few months. The US are obviously introducing tariffs. You've got retaliation from other countries. And so we've also heard reports of that having a significant impact on supply chains with goods stuck offshore until companies can understand what import taxes are due, and obviously what the impact of those tariffs will be on their profit margins. We've also seen that Donald's got a pain threshold, I think, and actually softened his position a couple of times as a reaction to the market. So I think there's certainly reason for optimism, and the markets have certainly stabilised post sort of March and April, where they were certainly up and down. I was actually attending a recent HSBC economic briefing, and it was interesting to hear that some of this trade war activity has actually led to a reduction in fuel and energy costs, so it has been helping slow inflation rates. And obviously we've seen recent interest rate cuts from the Bank of England, so there is optimism that business confidence can increase over the coming months. More positively, from an opportunities perspective, many businesses, including recruitment companies, are looking at diversifying, whether to explore new vertical sectors or new overseas markets and tap into those market trends across Europe, Middle East, and Asia in particular, as well as the US, despite the recent headlines. And we'll talk a little bit about that more in the session today. So narrowing it down specifically into the UK, businesses have obviously had to recently absorb the employers' NI increase. We've got the increasing costs of staffing as a result. We've also got a huge range of employment right law changes coming through in the ERB bill, which of course is going to add more cost and complexity into the supply chains that we all work in. I think the increase in the employers' NI and national living wage certainly hasn't helped increase hirers' confidence as they think about whether or not they want to hire more staff. But despite anecdotal reports, I think the level of redundancies hasn't been as great as some have predicted, but that isn't to ignore that certain businesses in certain sectors have certainly felt the impact. More narrowly, looking at the recruitment market, there's obviously been a tightening of that market, and we've seen an increased acceleration in insolvencies in the sector, unfortunately, over the past 12 months. So the outlook has been a little gloomy, and I'm sure you'll all be feeling the tightening of that sector. So what we want to aim to do today is to have a discussion about the risks that are posed, that we need to think about, and how you can think pragmatically and commercially to help navigate through those risks and generate profits. And our panel will share insights on that. We'd also like to hear from you. So please do share your insights via the chat function. If you have any specific questions that you want to ask the panel, then please do put them into the Q&A as we move through the conversation. But please do share some of the things that you're seeing in the market as well. It'll be super interesting for us to learn from each other and get a better picture on what is happening on the ground. So let's look at the topics that we're going to specifically dive into. Firstly, we'll look at market observations and comments on threats and opportunities. We'll then move into specifically the recruitment market nuances, how supply chains such as managed service provider programs can be navigated and the challenges that can pose from a funding and credit insurance perspective. We'll look at best practice that you can use to balance risk when you're writing business and what the available solutions are in the market that can help reduce credit risk and also your access to funding. And we'll try and leave about 10 to 15 minutes at the end for questions. So let's kick off then and go into our first topic about what the panel are seeing in the market. Good afternoon, Dave. If you could please kick us off by giving us a bit of a summary of the activity that you see from your customers at the moment.
Yeah, thanks, Dan. Thanks for letting me be on the call. I think, as you mentioned in the introduction, obviously our clients all have trade credit insurance policies, and one of the parts of a credit insurance policy is that overdue accounts need to be reported. And what we've seen, I would say the last 12 to 18 months, is an increase in the volume of late payments being reported to the insurers. When we say late payments, obviously very few people pay on the due date, unfortunately. But our sort of definition in the credit insurance world is typically 60 days beyond the due date. So if an invoice hasn't been paid 60 days beyond the due date, that needs to be reported to the insurance company. As a broker, we get involved with our clients with them reporting that to the insurers, and we've definitely seen an uptick in the volume. We've also seen, linked to the sort of on the subject of sort of late payment from the customers, is the reasons for not paying. What we're actually seeing is a lot of end customers disputing invoices. Now, it's a difficult one because we never know whether it's a genuine dispute. Is there something wrong with the invoice? If it's time and materials, is the day rate incorrect on the invoice? They invoice the incorrect number of hours, etc. Or being a bit more cynical, are people just throwing disputes in there as an excuse not to pay? One way or another, that we're seeing an increase in the sort of number of reports of people not paying on time. again, linked to that sort of process, with a number of the insurers, their policies include debt collection. So once that debt has been reported to the insurers will take over the debt collection. There's been a lot of sort of legal action, so intentions, sort of winding up petitions, things like that, where people have dragged that payment out as long as possible, and then we're seeing a payment come in. So again, it's difficult to know whether people are genuinely having a cash flow problem or they're just trying to sit on their cash as long as they can because of everything that's going on in the market, all the things you mentioned, tariffs, NI, everything else. I think that uncertainty means people want to sit on their cash as long as they can. So we're definitely seeing that with our clients, and as I say, the payment sort of cycle and the debt turn. You touched on the level of insolvencies, and unfortunately it has increased. So we are seeing an increase in the number of claims. I suppose the silver lining is that's what credit insurance is there for, is to protect against people becoming insolvent and not being able to pay their invoices. So we've definitely seen an increase in the number of claims. What I would say on that front is there is that sort of ripple effect. So last year there were a lot of big insolvencies, especially in the construction world. So ISGs, Henry Construction, Buckingham Group, that the list goes on. Obviously, those large companies failed, were unable to pay their suppliers, and that sort of knock-on effect goes down the chain, unfortunately, down to the people providing the labour at the start of the process. So we've seen an increase in the volume of claims coming through again in the last sort of 12, 18 months. More on the insurer side, obviously, in terms of the clients, as I say, we're seeing sort of late payments, claims. More on the insurer side, what we are seeing from the insurers is an increase in requests for up-to-date management accounts on businesses. So when the insurers are doing their credit checks on companies, it's more difficult at the moment to rely on publicly available information. So filed accounts, obviously, as we know, they're out of date the minute they're filed. And especially with everything that's been going on over the last few years with COVID, businesses taking CBILS loans, etc., when the interest rates were very low. Interest rates have crept up. People have now got to service that debt. Then you've got all the other things overlaid on top of that. So the insurers really want to get an up-to-date picture of how is business looking today rather than how was it looking in 2023, because a lot of time has passed. So
yeah, that's fair. That makes sense. I mean, as we said, market is super dynamic at the moment. Things are changing all the time. So trying to make decision making on accounts that are probably already 12 months old is tricky. So I think that makes sense. And actually, I think sometimes when we're in the middle of requesting information to be shared between you guys and hirers and recruiters, sometimes there's a bit of reluctance. Oh, should I be asking for this information? But actually, I think it shows a good level of engagement with a client, and you can actually get a much better understanding of what's going on with the customer as well. So you should properly engage with that process.
No, 100%. And from the insurer's point of view, anybody that's not willing to provide management accounts or be open with the insurer is going to make the insurer fear the worst. So the insurers will always say, communication and transparency is the best policy. If they can talk to somebody, even if the numbers don't look great, the numbers are always only sort of half the story. If that business is willing to talk to the insurer and give a bit of the narrative around their strategy, plans, what's in the pipeline, maybe they've restructured, etc. But if insurers don't know that, they can just go on what they can see, which is just numbers. So we're definitely getting more involved in that process. But I'd say that they're the main things we've seen in sort of recent months.
Okay.
Brilliant. Thanks, Dave. Alison, it'd be good to bring you in here and also share your insights in what you see in the market.
Yeah, thanks, Dan, and nice to see everybody this afternoon. Dave, I completely agree, and I can see what the same things happening across the market. I think one thing we've noticed is that because the environment has changed quite markedly over the last 12 months, people who are running businesses are seeing that a different approach is needed and actually engaging much more. And the request for management accounts, for example, as you said, have been much more forthcoming. And I think end clients quite welcome that open conversation. So we are seeing definite change in how people are approaching these things. And obviously, you know, we've seen some sectors just coming up to the top level. We've seen sectors kind of flatlining. We are beginning to see, I don't know if it's too early days, but some uptick in construction and health. So we'll see how that goes. The minimum wage and the national insurance are obviously having an impact, although again, I think that's early days. It's only really the first month and that hasn't flown through to cash flow yet because the payments are only just due. What we are seeing is people using that as an opportunity, quite rightly, to go and talk about their margins and having that hard conversation, which, you know, you really don't particularly want to do, but you need to be able to pass on and make your margin and keep your margin straight. So I think for us, it's seen a market changed in how people are approaching businesses and having a look at more awareness of this risk and cost, and being aware that they are giving credit, and credit that they're giving to their end customers is a really valuable thing, and don't undersell it. So I think that's really the main things that we've seen, some hard kind of essential conversations. But coming back to Dave's point, making sure that you have, you know, you engage with your end customers at a really early stage and say to them, look, this is what we'll need from you, is a really important thing. On the opportune side and looking at the opportunities out there, obviously some sectors might have some more money coming into them from the government. We're talking about construction, we're talking about some new health things, and a lot of we're seeing kind of a lot of awareness and people thinking, how can we get good and ready for those opportunities to come in? So that's what we're really seeing, Dan, overall.
No, that's great. And I do think, you know, again, it's not soft soaping anyone here. There definitely is signs of optimism out there with the breadth of businesses that the group engages with. We can see through numbers that we process that April was actually quite a strong month. May a little bit lower, but you expect that because we had bank holidays, etc. So there's definitely doesn't feel as much doldrums as we perhaps have had for the past 6 to 9 months. So there's definitely some movement there. So reasons for cautious optimism, I think.
I mean, we've got the spring budget, haven't we, that announced 1.5 million new homes and 625 million of funding. So hopefully that flows through to lots of different sectors, not just construction.
Yeah, absolutely. And so thanks for that, Alison. And just as a quick reminder to everyone, please submit your market observations in the chat as well as the guests are speaking. It'd be great to hear from you about your experiences and what your feelings are in the market as well. And if you have any specific questions that you want to pose to Alison and Dave, then please use that Q&A function for that. Okay, so Alison, if I can stay with you, then it'd be good to hear a little bit more about what this means for one of your recruitment clients, and if you could talk us through some of the particular recruitment nuances that you see, given your experience in providing finance across many sectors over your career.
Okay, no, thank you, Dan. And recruitment, whilst a sector in itself, obviously deals with numerous sectors. So it's a similar thing that they, you know, that our recruitment clients have to look at all different sectors and as they're dealing with them. And I think I'd put it in a few headlines, Dan, really, that keeping busy with the management of cash flow, so that actually they are really looking at that cash flow. And I suppose the things that we've always said in the past about, you know, managing your cash flow, looking at risk is now actually very much in our clients' minds as well. So that's good. They are taking the opportunity, because there seems to be a bit of a pullback in permanent recruitment, as I think we've all seen. They're looking to see whether they should set up a temp desk. And I think that that's a point that as we kind of come out of where we are now, and maybe some companies haven't recruited permanent, that actually temp will be more in demand. So we are definitely seeing that. And we're seeing, coming back to the awareness of knowing your value, I suppose, and knowing that if say there's a couple of transport in particular, asking for extended terms, make sure you understand what that's going to cost you on your margin. Do yourself a costing model, and we're helping people look at that and say, okay, I can do that for you, subject to credit insurance, if Dave and the likes of Dave will give the credit insurance, but make sure that you obviously price it in. So I think that's kind of what we've seen a lot more, really. And I think getting ready a temp desk, using this opportunity to kind of get match fit. So looking at your all of your processes, all of your systems, look at automation, because of course automation reduces cost. So that's what we're seeing, cost reduction and thinking about the future for top line.
Yeah, and I think so. It's interesting that you mentioned the match fit point, Alison, because actually we're going to be looking at doing a webinar in the next coming months or so with a business called Enablis that help companies review operational change, and they'll feed into some of the themes that they're looking at. You know, when it is a little bit more fallow out there and slower, it gives you an opportunity to reflect internally and slicken up the model, and obviously that can bring cost-effective benefits, but also potentially new angles and new products to sell to the market as well. So that's interesting. Dave, it'd be good to come back round to yourself now then. If you could just tell us a little bit more from a credit insurance perspective, how you see the recruitment market and some of the considerations that you have to bear in mind when you're looking at supply chain risk in that sector.
Yeah, absolutely. A bit like Alison sort of mentioned, you know, recruitment covers all sectors. As a credit insurance broker, we have clients in all sectors, but specifically for recruitment, there's probably two common themes when we're looking at putting a policy in place for a recruitment agency. The first one is that a lot of agencies have funding in the background, so an invoice finance facility, one form or another, and because of that, credit limits are key. So the funding available to the business is directly linked to the credit limits we can get from the insurers. So that is a common theme we see. And I would say the other common theme for recruitment is the managed service providers, where there's a pay when paid contract in place. But just touch on those two things. So with the limits, as I said, limits are crucial, and any business that has credit insurance needs a limit on their customer. But when there is funding involved in the background that relies on a limit, it's even more important. So our job as the broker is to try and explore all options, really, to try and get as much cover for our clients as possible, which could be just us purely appealing with the insurers and going into battle on behalf of the client and sort of disagreeing with the insurers over their interpretation of a set of accounts and trying to push them to sort of increase the limit. There's other options and solutions, which I think I'll touch on a bit later. But also, a bit like we mentioned earlier, we're sort of happy to talk to the end customer to kind of explain where we fit in the process and try and get those management accounts or put them directly in touch with the insurer. So getting the right level of cover is really critical, because if somebody's asking for a credit limit on one of their customers of £200,000, if they can't get that limit, and that means they don't get the funding, you know, going back to what we mentioned earlier, that's a real impact on their cash flow. So that's really crucial.
Dave, can I just ask around the MSP? Yeah. Because one of the things I've seen is sometimes it's really trying to understand who the actual debtor is, because you can be asking for a limit on the wrong party, where actually, you know, you are going direct to the end client, or you've got some shared approach here. So I think, you know, the terms and conditions are quite important, and you can actually negotiate where the risk sits as well as a recruitment agent. We've seen that with some of our clients have gone and actually negotiated to get the risk to sit in the best place that allows them to mitigate it with credit insurance.
No, 100%. Yeah, no, absolutely. Because we get a lot of agencies where it's take it or leave it. It's if you want to deal with us, you have to go this route, and the terms are pay when paid. One of the things that we sort of always sort of discuss with our clients is you've got to know who the principal to the contract is. So legally, you need to know who's responsible for paying that debt. I know from my previous life in the sort of the funding world, trying to fund invoices that are raised on a pay when paid through an MSP can be quite tricky, because technically there is no due date. If the MSP hasn't been paid by the end customer, it's very difficult to pursue them legally for that debt, which makes funding it more difficult. With credit insurance, there is a way around that. So what we actually do is, once we've established who the principals to the contract are, so who the MSP is and who the end customer is, what we will actually do with the agreement of the insurer is get credit insurance limits on both parties. So what you're covering off is both eventualities. So
Yeah.
if the end customer failed before they'd paid the MSP, the credit insurance will kick in, so you can claim on the insolvency of the end buyer. If the end buyer is still solvent and they've paid the MSP, but the MSP fails before they pass the money on to the agency, again, you can put a claim in. So you're covering the risk of either party defaulting. And by having that protection in place, hopefully that will allow the funder in the background to be a bit more comfortable, a bit more relaxed, hopefully be able to fund those invoices or increase the prepayment levels, etc. So there are solutions. It does depend on us being able to get sight of all the parties and get cover on all the parties. But that it's one of the first questions.
Practice. Anyway, I mean, I know that it's important for funding, but it's also important for a recruitment business because most of funders have right of recourse to a recruitment business. So insurance might be, you're thinking you're getting it just for funding, but you're not, you're actually getting it for the ongoing protection of your business as well. So it's always good to ask that question, whoever you're with, have you got both parties covered?
Yeah, no, absolutely. And it's one of the first questions we raise when we're talking to any recruitment company is there anybody on your ledger that's operating on a pay when paid basis and you know is an MSP? Because I think initially people just think, well, we have to discount that, we can't cover it, but we absolutely can. So I would say for credit insurance and recruitment, they're probably the two most common things that we talk to our clients around is limits, which is linked to funding, MSPs. What we're seeing more of is recruitment agencies sort of expanding into other markets, which could be export. As we know, it's very difficult to get financial information on businesses overseas. And this is where we can really tap into the insurers. These insurance companies are global. They have local branches all around the world. They've got access to a lot more information than is publicly available. So we are seeing a lot of recruitment companies looking to expand. And that's where the credit insurance can really add some value because it gives them that, yes, it gives them protection, but it gives them a bit of confidence and just a bit more insight into sort of who they're going to be dealing with or potentially dealing with overseas, which, you know, is a big thing because it is difficult to get information on overseas businesses. Something we have seen in the recruitment sector, which is linked to credit insurance as well, is where an agency is having to pay up front to a payroll company. So if it's a temp agency and they're paying the temps weekly, they may have to transfer the funds to the payroll company ahead of those temps being paid. Potentially there is a risk there that if that money's been passed to the payroll company, if something were to happen to the payroll company before the temps get paid, obviously that's going to cause a lot of problems for the temps themselves and the agency. There is a solution which is sort of linked to credit insurance, which is advanced payment protection. So it's effectively credit insurance, but in reverse. You're insuring the risk of your supplier going bust before they've fulfilled their obligation, but you've parted with the money. So we do see that in this world as well. So
that's interesting. That's very interesting. Not something that I was actually aware of, but of course, you know, as an umbrella company, as part of the group, you know, we're obviously needing that cash to come down. But of course, you know, is that recruitment agency going to pay us when actually we've got the liability of these employees that we need to pay as well? So everyone in the supply chain is thinking about those risk points. But it's interesting that you could see a recruitment agency actually having it both ways, nervous about being paid, and then also nervous about their payroll company actually paying the workers as well.
Yeah, absolutely. It's a shorter window of risk because typically the money is transferred and within 48 hours or so, the temps have been paid. But it's still a risk. It's a business risk at the end of the day. So
I suppose, Dave and Dan, recruitment agencies have to look at the risk of their customers and also the risk of their suppliers, because generally they are paying in advance. Tend to highlight that risk, and keeping them on credit safe or whatever other database you have is an important thing. But that sounds really interesting.
What we what we find quite often when we're talking to our clients is a lot of our clients will use a credit reference agency, so a Credit Safe, D&B, Experian. There's lots out there. What they will tend to do is just monitor their customers. They won't credit check their suppliers, and we always say it's equally as important. You know, if you're paying for this service, monitor your suppliers as well, because especially if you're heavily reliant on one of your suppliers, if their credit worthiness takes a bit of a nosedive, you need to be aware, you know, because that whole supply chain is really important.
So I think, Dave, that was super interesting. I think we're now starting to move into the specifics around, you know, the nuances around the recruitment market. So Alison, this is obviously very much part of your daily routine here in your role at Giant Finance Plus and keeping an eye on the risk and how things are moving. So could you share with us any practical advice on how recruitment agencies can manage that risk and access funding as well when it's required?
Okay, yeah, I'll certainly do that. I think just coming back to go on Dave's point, monitor your customers and your suppliers, make sure they're on Credit Safe, make sure that you've got that link, or ask your financer to do it for you. But know your customer, really, really know your customer, so that you, where we see people losing money is where they've maybe not known their customer well enough, not gone to visit their customer, not know where, you know, they're about, how they might raise. So credit insurance is one thing, but Dave has rightly picked up on disputes. So credit insurance is not valid if you have a dispute. So disputes are really critical to sort out. Now, most people in recruitment, particularly if you're talking about temps or perms in any shape or form, should have really tight terms and conditions. And for example, in a temporary scenario, if someone's saying, I don't like the work that this person's done or this IT work that someone's done, if you have that you don't have a duty of supervision and control, then you can refute that dispute straight away. So it's really important to know how you kind of almost have a flowchart of how you're going to deal with those disputes and make sure that whoever you're financing with, if you've got someone to do your debt collection, that they are flowing through those, because credit insurance is not relevant if there's a dispute. So you need to get onto those disputes quickly and make sure your terms and conditions are tight and signed so that people can't raise spurious disputes. And we have seen an increase in that, and Dave mentioned that earlier in his introduction. The other thing is have a costing model, however basic it is for yourself, because as interest rates have gone up, the cost of credit's gone up. And as you've got increases in national insurance contributions, that obviously is increased and might reduce your margin. So make sure you have your margin calculator with all of the costs involved within there. I would say this, wouldn't I? But outsourcing your collections is a really valuable thing. It divides the relationship between your sales and your front facing to be able to have somebody else who can talk to your clients in a different way, and makes it a little easier to have that division of conversation. So I think they're the things that I would really say are worth focusing on. If you're turning now to access of finance, Dave said earlier about people holding on to their cash. I think they are. Therefore, maximising your own cash flow is really critical. Ways to do that is obviously invoice finance. I should imagine most people are comfortable with that, but making sure that people aren't holding concentration limits and credit limits against you so that you do maximise your ability to use that finance. You've got banks, you've got other things available, but really the best type of finance for recruitment is invoice finance in some shape or form, because it grows with the business.
So listen,
so I think, you know, there are other forms of finance, Dan. Sorry.
No, so just on that point, just in terms of finance and sort of businesses sort of maximising their own sort of cash flow. Something we do get involved with quite a bit is where our clients supplier will be using credit insurance and they can't get a limit on our client, so that's restricting the amount of credit that they're getting. So if our
the chain is shorter, you need to make the chain as long as you can.
So if our client's credit rating is not the best, they might be having to pay pro forma to their suppliers, but they're having to offer 30-day terms to their customers, so it has a real impact on the cash flow. So something we get involved with quite a lot is talking to the insurers and introducing them to our clients to try and get their credit rating improved. So it's not just about getting limits on their customers. We try and get our clients' credit ratings improved. So our
so
clients
they can
will present
demand credit from their suppliers.
Yeah, it just potentially all helps from the sort of a funding point of view. If they can get 30-day terms from their suppliers, fantastic, rather than having to pay up front.
Yeah. Well, it's interesting if you've got, the cost of capital is about 0.5% of your margin if you're thinking about it from that blended rate. So if you can extend that by 60 days, then you get an extra 1% on your margin without even trying. And equally, on the other side, if people demand more credit, it is really equivalent to about 0.5% on your margin for 30 days.
Yeah, absolutely.
And I think that, again, as you guys were talking there, I was thinking about it from a commercial perspective. Some deals, especially MSP style deals, can be done over long periods of time where pricing's agreed. But of course, where you see these big fluctuations that we've seen in interest rates and the availability of credit, it's very, very dynamic. So pricing you need to be acutely aware of. If you're not reviewing that pricing, or you've not structured your contract correctly so that you can review that pricing over time, then you can be left with a real problem. I think the other thing that's just come out from you two speaking to each other there as well is that hopefully the audience can hear that there's numerous different ways actually that potentially a solution can be found, whether that's whether it is looking at the credit up or if it's looking at the credit down. So actively encouraging guys to engage with Alison and Dave and Verlingue to have those open conversations, because this is about putting a solution together to get business done for the benefit of everyone. So don't be closed off. There's often more than one way to skin the cat, so to speak. Dave, do you have anything further that you wanted to add in terms of solutions in the market that the audience should be aware of?
Yeah, no, definitely. There's just going back slightly before I jump into the solutions. Something that credit insurance is there to protect the business if things go wrong and the customers can't pay ultimately. But I've touched on how it can help with credit ratings, etc., finance. One of the other things that a lot of our clients use the credit insurance for is almost a sort of a sales enabler. So if they're applying for limits on their customers, if they're getting positive feedback from the insurer, that's a big green light to say, look, these guys are good for their money. Maybe you want to focus your sales efforts there. If the insurers are coming back saying that we're not very comfortable with this business for whatever reason, again, going back to what Alison said about knowing your customers, I think the agencies need to have that sort of grown-up conversation with their customers to say, look, we credit insure, we can't get you covered for whatever reason. We've got to start talking about payment terms because they have to manage that risk. So it can be used as a tool to sort of to negotiate payment terms. If somebody's coming back green light, the insurers say they're absolutely brilliant, maybe offer them extended credit terms if that means you're going to get more business. Obviously you've got to factor in the cost of that, as Alison says, credit costs, but if you can double your turnover with somebody by offering them longer credit terms, there's all these sort of little add-ons that businesses use the policy for. In terms of solutions, so a traditional credit insurance policy is what we call a whole turnover policy. So the client is insuring all the customers on their sales ledger, and all their invoicing, all turnover that goes through the business falls under the credit insurance policy. Outside of that, there are some quite bespoke solutions. So if you have a business, let's say you have an agency where their turnover is highly concentrated with one customer, they may not see the value in insuring all of their customers because 20% of their turnover is with a small number of customers, very small values. If they didn't get paid, it's not the end of the world. They're worried about the 80% of their turnover is with one customer. So we can get single buyer policies where you just insure a key customer. We can expand that and you can get policies where it's selective buyers. So for your larger business that might have 100 customers, but they're really concerned with the top 5, we can get policies that just cover the top 5. The other thing that we can source from the market is it's called top-up cover. So again, this is linked to the credit limits. So if a business needs a credit limit, for example, of £200,000 on one of their customers, their insurer says we can only do 100 based on our assessment of the risk. We might be able to go to other insurers to get them to write the additional 100,000 on top of the primary 100, so we can get our client to the 200 they need. So there's lots of options. What we always say is, if somebody is using credit insurance and they apply for a limit and they don't get the response, that's not the end of the conversation.
Mm-hmm.
You know, we can appeal it, we can go to the incumbent, we can look at other options.
So Dave, early conversations with everybody is really important. I think that's what we found. And if we do that, we
Absolutely.
can really help solve a problem or you know, create a massive opportunity for the client.
Yeah, I think it might sound odd, but I think the insurers, because the credit insurance market in the UK is relatively small, there's less than 20 insurers, you know, they are keen to write cover, but they need to have the transparency, they need to have that communication to allow them to do that. So yeah, early engagement is key.
Yeah, I was just thinking, as you made that point initially, as a salesperson, I've been guilty many times of finding a deal, getting super excited, and then all of a sudden you do credit checks on that business and then start to understand there's some challenges there, and you can be frustrated that you can't move that deal forward. But it's quite right that there's an element of control there, and really, you know, there's more than enough systems and tools out there where you can do that upfront bit of qualification, and actually it would have better flavored my sales conversation with the client as well. So doing your due diligence right at the beginning of the sales process is always good. I think the other thing that I was thinking about as you guys were talking as well was costs associated with this. Obviously, Alison's raised the point, funding costs, but as does the credit insurance. And we know for our business certainly does compete, we know, against other competitors who don't often pick up the cost of credit insurance. You know, they'll take risk there, which can put us at a commercial disadvantage. But you know, we've got a sleep at night position where we understand if there is a failure, then we're covered. So I'm sure you'll see that, Dave, from both sides of the fence, that not every organisation even bothers with credit insurance. You know, some will take real risk.
Yeah, I mean, broader than the recruitment sector, probably the uptake of credit insurance in the UK is less than 20% of businesses use credit insurance.
Wow.
Some of that is lack of awareness. Some of that is just purely, for example, if you've got a business where they have 500 customers and every customer owes £1,000, you have a very well spread ledger. You would need a lot of those customers to not pay before it has a real meaningful impact on the business's bottom line and their cash flow. So you could argue, you know, they could self-insure and manage the risks themselves. So there are reasons some businesses don't use credit insurance, and that's for them, that's the right thing. But for a lot of businesses, I think they should at least explore it, because as you say, it's the peace of mind. It's the what if, you know, if somebody does go bust and they don't pay £100,000, what's the impact of that on the business from a cash flow point of view, the bottom line? You know, if you work on 10% margins, if you have a £10,000 bad debt, you've got to generate an extra £100,000 of revenue just to plug that gap. So there's a lot of additional benefits of the credit insurance, but as I say, it does cost. There is a premium attached to it.
Yeah, absolutely.
If you're not purchasing credit insurance, you're self-insuring, so you need to kind of have that almost in your mind as a pot that you're prepared to lose, and that's, you know, obviously is a different business decision, but it sometimes makes sense.
Yeah, no, it's a good point as well on spread of customers as well. Obviously, if you're a recruitment business with 90% of your placements with one particular hirer, then maybe that's the point where you need to start thinking about taking some insurance out on that particular hirer. Whereas if you've got a really nice broad spread, which is generally not the case, I tend to see agencies have a couple of key clients, then perhaps you can take more of a blended risk. So again, every situation is different. So thank you both. That brings us to an end of our sort of set topics that we wanted to cover. Again, just encourage the audience, if you've got any questions you want to add in, now's the time, because we've got a couple to go through, but if you want to add any more, please submit them on the Q&A. But Dave, if I can come to you, one of the questions that we'd had is, how do you cost out credit insurance? So what are the factors that are in your thinking when the credit insurers are looking at costings here?
So the insurer's assessment is sort of split into two halves, really. So one half of the assessment is on the customers. So the insurer will typically they'll look at a sample of top 10 to 20 customers. From that, they'll get a flavour of who's that agency dealing with. Are they dealing with huge, very creditworthy companies? That's going to reduce the risk. Or are they dealing with a lot of new start businesses? It's going to make it higher risk. So one side of their assessment is on the debtor book and who the customers are and what limits are required. The other part of the assessment from the insurers is on the business itself, the recruitment agency. So what they're looking at is, how long has the business been established? What are their credit control procedures? Do they put people on stop, or do they just extend credit and hope that people pay? What's their bad debt history? So, and also what sector they are in. So as Alison said right at the very start, recruitment companies could be in pretty much any sector. A tricky one at the moment, if I'm being honest, is recruitment into construction. The construction sector is so volatile. So if you have an agency that is recruitment into construction and they've had a history of bad debts, that's going to push the premium up. On the flip of that, if you've got a recruitment agency with a clean history, no bad debts, and they're supplying into the transport or maybe IT sectors, it's a pretty soft market. We can get some really good rates, but generally that's how the insurers would assess the overall risk.
Okay, great. Alison, one here for you. So question come in, how does the giant finance proposition differ to the funding that's offered by the high street banks?
From a finance perspective, the proposition differs in that we provide higher prepayment percentage or percentages against the invoices, and we're not so concerned about restriction on concentration. So in high street banks, you'll tend to have a restriction, which obviously, as we've just discussed, is a problem for some recruitment companies because they do tend to be quite concentrated and it works for them. So we tend not to have any restriction on that. If we can get credit limits, then we can provide the finance. I think also what's different is we also couple it with lots of other things, Dan, as you know. We support the businesses in their growth overall with systems, credit control. We've got our screening, and obviously we've got all of giant group employment solutions. So we tend to be a more holistic solution. If you're just coming to us to replace finance, then I think the question is, how much more can we give? And also, I'd say we're very flexible and got very short lines of delivery. So if you need a facility increase, which happens, of course, when you grow, which is we're all hoping that happens over the next 6 to 12 months, we've got very, very short lines. So we can respond really quickly, whereas you do tend to, with banks do have obviously bigger credit committees, and it takes a little longer to get decisions. And I think Dave has had experience in the market as well. He'll probably back me up in that. So I think
Absolutely.
that's a benefit that you don't necessarily see until you need it. So I'd say that flexibility, generally more finance available, and also all of the added benefits that we can add.
I'd probably say as well, Alison, is you've got that sector expertise. If you're comparing you against a bank factor, they're trying to provide a solution to everybody. It's a bit, you know, you've got the actual knowledge of the sector and some of the nuances, I would say. Yeah,
which I think has helped us assist clients in MSP negotiations, in actually looking at the higher terms that people are asking for and being able to do that. So yes, I agree. Thank you.
Good. Okay, well, we had an observation come in that Brexit has obviously made, this person feels, Nassim feels that Brexit has made recruiting more and more challenging, which I don't think necessarily disagrees. Business in general perhaps has been more challenging post-Brexit. Question that occurred to me, actually, given that we see many recruiters looking at diversifying away from the UK and going into more international markets. How does that translate in the world of credit insurance and funding? Are there any restrictions on hirers having to be based in the UK or overseas? So maybe one for you to pick up first, Dave, and then Alison from a funding perspective.
Yeah, so from a credit insurance perspective, if you're talking about a UK agency that is now exporting, we can find a solution as long as the insurer can write the cover on the overseas customer, then that's fine. It doesn't matter if the turnover is domestic or export. If you're looking at a business, let's say a UK agency who then opens a subsidiary in France or Spain or Italy in Europe, something like that, we can structure the policy so that the subsidiary is added and we basically get a group policy. Different insurers approach it differently. Part of Verlingue, we have a solution where we can sort of work with European companies. If you're looking wider than Europe, Verlingue are members of something called the WBN, which is the Worldwide Broker Network. So if somebody wanted to open a branch or a subsidiary in Australia, Verlingue don't have bodies in Australia that could sort of service a policy. So we can tap into the WBN and find a local broker for them. So yeah, there's always solutions. Good.
Alison, have anything for you to add from a funding perspective?
I think, Dan, we can be a little bit of an island sometimes, in that it is easier to deal in the UK with UK. I think coming back to what Dave says, if you're a UK agency wanting to go overseas, then that's pretty able to be financed because you can get credit insurance overseas and you're dealing with your own business supplying workers, and that works really well. And you know what the legal framework is and where you're going to sue if you need to. Quite a lot of financiers don't like that and they restrict it to very small levels. We have a more of a broader view on that because we obviously have more insight. We've got Giant Global, so we can understand what it is in different countries. So we can do that. Where it becomes more challenging, and just being honest, it's the legal situation really, is where a UK entity wants to set up overseas, and particularly outside Europe. Saying what Dave says, whilst we can get credit insurance, we still need to get title to the book debt if we're going to finance it, and that has different challenges in different countries. It doesn't mean to say it's not possible, but you have to work with whichever financier you choose to see the solution you want and see if you can both put that in place together. But you'll see that a lot of the banks do stick with UK registered entities selling overseas.
Brilliant. Great. Listen, Dave, Alison, thanks so much for joining us today. I found that super interesting to go through it. I think one of the key themes that's come out for that for me is communication, speaking to your customers, speaking to your suppliers, not always looking for an obvious solution. There could be other angles that your businesses can bring to help recruiters do business both in the UK and internationally. We will follow up with a recording off the back of this. So thank you to the audience for attending. A recording will go out on follow-up. We'll make sure we include Alison and Dave's contact details. If you've got any specific questions, then please do feel to reach out. And thanks for joining and have a great afternoon, everyone.
Thanks, Dan.
Thank you, Dan. Thank you, everyone.